This one number decides whether banks trust you or reject you. In this video, I'll explain credit score explained in simple terms in the simplest way possible. No confusing terms, no financial advice, just education to help you understand how the system really works. Section 1. Core concept. What a credit score actually is. A credit score is a number that represents how the financial system views your past behavior with borrowed money. That's it. It is not a measure of how smart you are. It is not a measure of how rich you are. And it is not a judgment of your character. It's simply a risk indicator. The system asks one basic question. If we give this person money today, how predictable are they in paying it back? Your credit score exists to answer that question quickly, without having to know you personally. Why credit scores exist? Modern financial systems deal with millions of people at once. Banks cannot sit with every individual and understand their life story. So instead, the system uses past payment behavior, timing patterns, consistency. All of this gets compressed into one number. That number allows institutions to approve or reject applications, set interest rates, decide limits and terms. From the system's point of view, this is efficient. Why people use credit scores, even if they don't think about it. Most people don't choose to use credit scores. They encounter them when renting a home, buying a phone on installment, applying for a loan, getting a credit card, sometimes even for jobs or utilities. So even if someone says, "I don't care about credit scores," the system may still care about them. That's the key difference. Section 2. System design. How the credit score system works, step by step. Let's break it down simply. Step 1. You borrow or use credit. This could be a card, a loan, or any approved credit line. Step 2. Your behavior gets recorded. Not your intentions, not your reasons, only actions. When you paid, how much you paid, whether you were late, how often you used credit. Step 3. Data flows to scoring models. These models don't know why something happened. They only detect patterns. Consistency looks safe. Irregularity looks risky. Step 4. A score is generated. This score updates over time as behavior changes. No emotions, no context, just math. Money flow and control flow. Here's something most people don't realize. Credit scores are not designed to help you first. They are designed to help the system decide. When risk looks low, money becomes cheaper. Access becomes easier. When risk looks high, money becomes expensive. Access becomes limited. This doesn't mean the system is evil. It means the system is incentive-driven. How institutions benefit from an institutional perspective: predictability reduces losses, data reduces uncertainty, scores reduce human judgment errors. The more predictable behavior is, the more confidently money can move. That confidence is where billions are made, not through tricks, but through structure. So now you know what a credit score really is and why the system depends on it. But here's the uncomfortable part. Most people don't lose money because they're irresponsible. They lose money because of small behaviors they never realized mattered. And that's where things start to go wrong, quietly. Section 3. Common mistakes. Most people don't realize they're doing anything wrong. Most credit score damage doesn't come from big, dramatic failures. It comes from small, repeated actions that seem harmless at the time. That's why people are often confused when their score drops. From their point of view, nothing bad happened. From the system's point of view, patterns changed. Mistake 1. Thinking late is late, one day doesn't matter. To a human, one day late feels insignificant. To the system, late is late. The system doesn't measure effort or intention. It measures timing consistency. So when payments shift from always on time, sometimes late, the pattern changes, and the system reacts to patterns, not excuses. Mistake 2. Using credit casually because it feels like your own money. When money is digital, it feels abstract. Swiping, tapping, or clicking doesn't trigger the same caution as cash. So people start thinking, "I'll handle it later. It's fine this month. I'm still paying something." But the system doesn't evaluate feelings. It evaluates utilization and behavior frequency. High usage plus relaxed attitude equals increased perceived risk. Mistake 3. Closing accounts without understanding the signal. Many people believe, if I close an account, it means I'm being responsible. Emotionally, that makes sense. Systemically, it can do the opposite. Closing accounts changes your history length, your overall credit structure. To the system, sudden structural changes can look unstable, even when your intention was control. Mistake 4. Ignoring small balances or infrequent activity. Another common thought: it's a tiny amount, it doesn't matter. But consistency matters more than size. Irregular activity sends a signal of unpredictability. Silence also sends a signal. The system prefers steady behavior, repeating patterns, predictable cycles, not extremes, either heavy use or complete neglect. Mistake 5. Assuming the system understands your situation. This is one of the biggest misunderstandings. The system does not know. If you had an emergency, if income was delayed, if life got complicated, it only knows what shows up as data. So when people expect empathy from a system built on math, disappointment is almost guaranteed. Why these mistakes are so common? Because the system feels invisible, works silently, reacts slowly. There is usually no immediate feedback. By the time people notice a problem, the behavior has already been recorded for months. That delay creates confusion. I've been doing this for years. Why is it a problem now? The answer is rarely one action. It's accumulation. At this stage, most people realize something uncomfortable. They weren't careless. They were uninformed. And the system didn't break. It did exactly what it was designed to do. Understanding this changes how you see the problem, but it still doesn't show you how to think differently yet. That shift comes next. Section 4. How smart users think. Smart people avoid panic, not systems. Once people understand how the credit system works, something important changes. They stop asking, how do I beat the system? And start asking, how does the system think? This is the key shift. Smart users don't try to escape systems. They learn to operate calmly inside them. Discipline over emotion. Most financial mistakes are emotional, not logical. Stress leads to rushed decisions, inconsistent behavior, short-term relief thinking. The system, however, rewards the opposite: stability, repetition, predictability. Smart users understand this mismatch. They don't react to fear or urgency. They focus on behavioral consistency, even when emotions fluctuate. Thinking in systems, not moments. Here's a core difference. Most people think in moments. The system thinks in timelines. A single action rarely defines anything, but repeated actions define a pattern. Smart users zoom out mentally. They think in months, not days. Cycles, not incidents. Structure, not exceptions. This reduces panic and impulsive reactions. Mental models. Institutions. Institutions don't think like individuals. They think in terms of risk distribution, probability, long-term exposure. From their perspective, one late payment isn't a story, it's a data point. Smart users adopt this lens. They stop personalizing outcomes and start recognizing signals. Power comes from predictability. In financial systems, power doesn't come from income alone. It comes from reliability, track record, behavioral history. Predictability lowers uncertainty. Lower uncertainty reduces friction. That's why calm, boring behavior often has better outcomes than aggressive or emotional behavior. Long-term thinking versus short-term relief. Short-term thinking asks, how do I fix this right now? Long-term thinking asks, what pattern am I creating? Smart users prioritize continuity over quick fixes, structure over shortcuts, process over urgency. This doesn't mean perfection, it means awareness of accumulation. Why this mindset changes everything. Once people stop seeing the system as personal, they stop feeling attacked by outcomes. Instead of confusion, they gain clarity. This result came from this pattern. If patterns change, outcomes change. No fear, no blame, just understanding. At this point, the system no longer feels mysterious. It feels mechanical, and when something becomes mechanical, it becomes easier to navigate without stress. What's left now is the big picture. What changes when this awareness compounds over time? The long-term view. What changes when you understand the system? When people truly understand how the credit system works, the biggest change isn't financial, it's psychological. Money stops feeling like a threat and starts feeling like a structure. That shift alone removes a lot of fear. From confusion to clarity. Before awareness, outcomes feel random, decisions feel stressful, mistakes feel personal. After awareness, outcomes feel explainable, decisions feel calmer, mistakes feel informational. Nothing magical happens overnight, but uncertainty drops, and uncertainty is what creates most anxiety. Control doesn't mean power, it means predictability. Most people think control means more money, more access, more options. In systems like this, control actually means fewer surprises, stable outcomes, clear cause and effect. When you understand the rules, you stop guessing, and when guessing stops, panic stops. How awareness compounds over time. Awareness works quietly. Month after month, patterns stay stable. Decisions feel less reactive. Financial events feel less dramatic. The system doesn't reward intelligence. It rewards consistency. People who understand this don't rush. They don't chase fixes. They don't fight the system. They let structure do the work. Money without fear. The final shift is emotional. Money stops being something to fear and becomes something to observe logically. Not good or bad, not moral or immoral, just inputs and outputs. That's the level where real confidence forms. If this helped you understand the system better, consider subscribing for more educational breakdowns like this. Understanding systems doesn't make you rich overnight, but it does make you calm, aware, and hard to surprise.